In this video, I'm going to give you an algorithm to detect and confirm a high-quality trade in a simple way from scratch, meaning from the moment you open a blank price chart until the triggering of the trade. Most traders learn some kind of trading technique, but they usually have no idea how to implement it once they open a blank chart, meaning they have no idea how to start detecting and then confirming a possible high-quality trade opportunity. Not only do traders want to trade with high quality, but they also want to trade with high frequency. At this point, it's common knowledge that traders should combine trading techniques in order to enhance the chances of success in a particular trade. However, no one really talks about an objective way of doing that from opening the price chart up to the triggering of a high-quality trade opportunity. Perhaps even worse than that, no one really talks about the pitfalls and secrets of how to do this in an objective and simple way. Before we move on, you should understand that this idea of combining trading techniques is the most important principle in technical analysis, and it's called the principle of integration. When we trade at the intersection of different trading techniques, we are trading when traders that subscribe to different methods and techniques act in unison. For this reason, when we trade at the intersection of techniques, there's a much higher chance that the trade will be successful. The basic detection and confirmation algorithm of a trade goes like this. Once you open a blank chart, the first step is to detect a signal from one trading technique that you like. The first signal is just a warning, it's not a trigger. The second step is to confirm this initial signal. The way you do that is by trying to see if you can find other trading techniques intersecting with the first signal. You notice that if it's easy to find intersections, you are probably facing a high-quality trade opportunity. If it's difficult to find intersections, there are two possibilities. Either you are facing a bad trade opportunity, or you don't have enough knowledge to actually perceive the intersections that might be happening. This solution is in the right direction, but it is incomplete. What follows is a brief list of pitfalls with this, and then after that I will give you the keys to solve all of them. What kind of technique should you choose for the signal and confirmation? Broadly speaking, there are two types of trading techniques, the ones that have lag and the ones that are devoid of lag. Lagging techniques are things like moving average crossovers, following the direction of a moving average, oscillator crossovers, and etc. Techniques that are devoid of lag are things like multiple types of support and resistance, lines, channels, pitchforks, candlesticks, volume, momentum, and pure price action reading. You should focus only on techniques devoid of lag because that allows you to optimize your entries, minimize your stop losses, and maximize your take profit targets. That has the effect of generating trades that will sustain you in the long term, which is the main goal of a trader, or at least it should be the main goal of a trader. How many techniques should you integrate in order to generate high-quality trades? There is no maximum number of techniques you should integrate. The more non-lagging techniques you integrate, the higher the quality of your trades, meaning the higher the chances of success. However, there is a trade-off between quality and frequency. In other words, the trades that integrate many different techniques have a much higher quality, but also a lower frequency, meaning that they don't appear very often. Even though the maximum number of techniques to integrate is not clear, there is a minimum number of techniques to ensure at least a decent level of quality. I would say that a minimum of 3 different techniques must be integrated in order for a trade with decent quality to occur. Keep in mind that this is the absolute minimum. It's far from being what the optimal number is. Do you have enough knowledge to spot high-quality trades in the chart? If a trader cannot spot integrated trades in the market, there are only 2 possibilities. Either the integrated trade opportunity is not there, or the opportunity is there, but the trader simply doesn't have the knowledge to see the opportunity. The only way to make sure you see as many integrated opportunities as possible is to study technical analysis as much as possible. If you focus only on one trading technique or method, you will be disappointed. The more techniques you know, the greater the number of high-quality trades you'll be able to see, and the more frequent these trades will be also. Not all integrated trade opportunities are created equal. Certain kinds of integrations are more powerful than others. Here we have the idea of vertical, horizontal, and hyper-integration. Imagine that in technical analysis, we have several kinds of methodologies. We have pure price action reading through candlesticks, patterns, and trend phase analysis, volume, velocity, volatility, indicators, and the list goes on. These are all different methodologies within technical analysis. Each of these methodologies is composed of a series of techniques. For example, volume analysis is one methodology. Inside the method of volume analysis, we have various trading techniques like VSA, volume at price, volume at time, anchored VWAP, and so on. In the horizontal axis of the chart, we have the different kinds of methods, and in the vertical axis, we have the different kinds of techniques. There are trade opportunities where you will find the intersection of multiple techniques of one single method. For example, you will find several volume trading techniques converging at the same time. That is called vertical integration. This is the weakest type of integration, although is a lot better than trading based on one technique in isolation. Horizontal integration, as you can imagine already, is when we find the intersection of different techniques across different methods, usually one technique from at least two methods. Horizontal integration tends to be stronger than vertical integration because it combines the power of different groups of traders in a more prominent way. One simple example of horizontal integration would be a trade that combines a candlestick pattern with momentum divergence and Elliott wave analysis. 3 techniques from 3 different methods. The third option is hyperintegration, which is the combination of vertical and horizontal integration in a way. This is simply the combination of multiple techniques from multiple methods, where more than one technique per method is used. Several techniques from each method are used, as well as multiple methods. As I said earlier, the greater the integration, the higher the quality. An example of this would be a contextual analysis that considers price action reading, trend phase analysis, volume, momentum, volatility, cycles, and so on. A large number of techniques that allow the trader to understand what the market will do next. Notice that a trader can trade with setups or with contextual analysis. Each one has its pros and cons. Setups are objective and easy to see for the most part. However, to increase the quality of a setup, the level of integration must also increase, and that inevitably leads to a lower trade frequency. Contextual trading, which is done mainly through hyper-integration, is more difficult to do and it can be overwhelming even for experienced traders. However, contextual trading allows you to analyze any market situation, and that of course increases the frequency in which you can trade with high quality. Instead of waiting for the correct setup to align, you can analyze any market situation on command. Hyperintegration is a much deeper subject, so I will leave that for another time. I have a video showing a hyper-integrated analysis in the channel, so if you are interested, you can check that out in the YouTube card. The following algorithm works if you want to focus on high-quality setups. By the way, high-quality setups can be part of a broader context produced in a hyper-integrated analysis. The first step is the detection of a possible high-quality trade opportunity. Once you open a blank chart, you must scan the chart for any signal that comes from a technique or method that is devoid of lag. The more techniques and methods you know, the more signals you'll be able to spot, and therefore, the more frequently you can trade with high quality. The 2 keys here are looking only for techniques that have no lag and knowing as many of those techniques as possible. This solves the main problems with the detection part of the algorithm. Remember that this first technique is just a signal. A signal is just a warning, it's not a trigger. The second step is confirmation, which is done by integrating other trading techniques that are devoid of lag. Ideally, you want to use horizontal or hyper-integration, although vertical integration is still better than simply acting on the first signal without any integration at all. I would say that a minimum of 3 techniques are necessary to produce trades with reliable quality, but the more you integrate, the higher your chances of winning. As I said earlier, one problem you find here is that setups becomes less frequent as their quality increases. The solution to that is to use a contextual trading approach, but that requires a more sophisticated type of market analysis. The bottom line here is that you must detect the first signal and then integrate it. Don't try to find intersections out of nowhere because that is too hard. Another way of looking at this is that you must have an initial spark provided by a technique that is devoid of lag. Once you have that spark, you must employ your greatest effort in order to justify that first technique by integrating it with other techniques, preferably from multiple methods within technical analysis. To finish this video, I want to give you a practical example of what I'm saying. Take a look at this price chart. It has no analysis yet. The first step is to use one technique devoid of lag as a first signal, keeping in mind that a signal is just a warning that a high-quality trade opportunity is present. It's not a trigger for you to buy or sell yet. One of the good techniques you can use for the first signal is the supply and demand zone. In this next chart, the current price action is bouncing from a well-established supply zone. The supply zone was drawn using the inward and outward frequencies of a major high, something you can learn more about in my premium courses in the video description. We have the first signal. This is the initial warning that a high-quality trade might be present. Now we must make the maximum effort in order to integrate as many techniques as possible in order to confirm this initial idea. In the current price action, we can see that once price entered the supply zone, it produced an outside fractal candle to the downside. This is evidence that sellers are still powerful in that zone. Notice also that this outside fractal candle breaks the dynamic frequency of the last upward price vector. If we take a moment to think about this, we already have three types of confirmation: the outside candle, the fractal bar, and the dynamic frequency breakout. However, these three techniques are vertically integrated, meaning that they all come from pure candlestick analysis or pure price action reading with candlesticks. Ideally, we want to engage elements of horizontal integration as well. For that purpose, I want to use a tool from regression analysis called linear regression channel. The reason why the regression channel is useful can be traced back to chaos theory. If you want to learn more about that, you can check the first volume of my advanced trading course. In this chart, I plotted the linear regression channel from the high out of which the supply zone comes out up until the most recent candle that bounced off of the supply zone. Notice that a linear regression channel works similarly to the pitchfork, and we can observe an overthrow in the lower line. Based on that, we can draw an overthrow in the upper line as well. Once we do that, it's clear that the current outside fractal candle bouncing from the major supply zone is also respecting the upper overthrow of the linear regression channel almost perfectly. You may think that I'm simply overfitting the analysis to the original idea from the supply zone, and you are absolutely correct to think that. What most people fail to realize is that this is exactly what you need to do in real time. You need to attempt overfitting the analysis to an original idea through the process of integration. Now I want to add another layer of confirmation here through velocity analysis using the RSI. The green lines highlight the fact that the current price action is showing a bearish continuation divergence, which is marked by lower highs in price and higher highs in an oscillator like the RSI. The current fractal candle also increases the strength of the velocity signal in terms of divergence. Notice how the fractal candle is a technique that belongs in different methods. We can see it in terms of price action, but we can also see it in terms of velocity. In summary, the first signal or the spark for this short trade idea is the major supply zone. In order to confirm it, we integrated an outside fractal candle that produced a dynamic frequency breakout, the overthrow of a linear regression channel, and a simple continuation divergence. One technique from supply and demand, three techniques from pure price action reading, one from linear regression, and one from velocity divergence. A total of 6 different techniques. However, there is a little bit of vertical integration in terms of pure price action reading, which is okay. If we move forward in time, we'll see that this was indeed a major reversal point in the market. This is an example of high-quality trade opportunity that began with a simple idea and then became something else through the use of integration. Trades will not happen in the exact same way. There is a great level of variation in how high-quality trades emerge, so it's important to keep that in mind. That's it for this video. I hope this information is useful in some way. If you want to learn more about trading techniques that are devoid of lag and that can be used in integrated trading, check out my premium courses in the video description. If you enjoy what I do and wish to support the channel, please click the like button, subscribe to the channel, activate all notifications, leave your feedback in the comment section, and share the video. Thank you very much for watching, and I hope to see you in the next videos. Take care.